Trading psychology. What is trading psychology? Trading psychology refers to the emotions and mental state that help dictate success or failure in trading securities. Trading psychology represents various aspects of an individual's character and behaviors that influence their trading actions. Trading psychology can be as important as other attributes such as knowledge, experience, and skill in determining trading success. Discipline and risk taking are two of the most critical aspects of trading psychology, since a trader's implementation of these aspects is critical to the success of his or her trading plan. Fear and greed are commonly associated with psychology, while things like hope and regret also play roles in trading behavior. Key takeaways. Trading psychology is an emotional component of an investor's decision making process, which may help explain why some decisions appear more rational than others. Trading psychology is characterized primarily as the influence of both greed and fear. Greed drives decisions that appear to be too risky. Fear drives decisions that appear to avoid risk and generate little return. Behavioral finance has documented several psychological biases and errors involved when making trading or investment decisions. Understanding trading psychology. Trading psychology can be associated with a few specific emotions and behaviors that offer catalysts for making market trading. Conventional characteristics of emotional driven behavior in markets are describe most emotional trading to either greed or fear. Greed can be thought as an excessive desire for wealth, so excessive that it clouds rational and judgment at times. Thus, this characterization of greed inspired investors or irrational trading assumes that greed emotions can lead traders towards a variety of suboptimal behaviors. This may include making high risk trades, buying shares of an untested company or technology, or just because it is going up in price rapidly, or buying shares without researching the underlying investment. Additionally, greed may inspire investors to stay in a profitable trades longer than is advisable in an effort to squeeze out extra profits or to take large speculative positions. Greed is most apparent in the final phase of bull markets when speculation runs rampant and investors throw caution to the wind. Conversely, fear causes traders to close out positions prematurely or to refrain from taking on risk because of concern about large losses. Fear is palatable during bear market and is a potent emotion that can cause traders and investors to act irrationally in their haste to exit the market. Fear often morphs into panic, which generally causes significant sell-offs in the market from panic selling. Regret may cause a trader to get into a trade after initially missing out on it because the stock moved too fast. This is a violation of trading discipline and often results in direct losses from security prices that are falling in peak highs. Technical analysis. Trading psychology is often important for technical analysis, relying on charting techniques to drive their trade decisions. Security charting can provide a broad array of insights on securities movement, while technical analysis and charting techniques can be helpful in spotting trends for buying and selling opportunities. It requires an understanding and intuition for market movements that are derived from an investor's trading psychology. There are numerous instances in technical charting where a trader must rely not only on the chart's insight, but also their own knowledge of the security that they're following and their intuition for how broader factors are affecting the market. Traders with keen attention to comprehension security prices, influences, discipline, and confidence show a balanced trading psychology that typically contributes to success. Behavioral finance. Part of trading psychology is to understand why individuals make irrational decisions in the market or other money matters. Behavioral finance is a subfield of behavioral economics that proposes psychology, influences, and biases that affect the financial behaviors of investors and financial practitioners. Moreover, influences and biases can be the source of an explanation of all types of market anomalies, specifically those in stock market like severe rises or falls in stock price. Behavioral finance typically encompasses the concept of mental accounting. Mental accounting refers to propensity for people to allocate money for specific purposes. Herd behavior. Herd behavior states that people tend to mimic the financial behaviors of the majority of the herd. Herding is notorious in the stock market as it causes behind dramatic rallies and sell-offs. Emotional gap. The emotional gap refers to decision making based on extreme emotions or emotional strands such as anxiety, anger, fear, or excitement. Emotions are often key reason why people make rational choices. Anchoring. Anchoring refers to attaching a spending level to a certain reference. Examples may include spending consistently based on a budget level or rationalized spending based on different satisfaction utilities. Self attribution. Self attribution refers to a tendency to make choices based on overconfidence in one's knowledge or skill. Self attribution usually stems from intrinsic knack in a particular area. Within this category, individuals tend to rank their knowledge higher than others, even when it is objectively falls short. Example: loss aversion. Loss aversion is a common psychology error that occurs when investors place a greater weighting on the concerns for losses than the pleasure from the market gains. In other words, they're far more likely to try to assign higher priority to avoid losses than making investment gains. As a result, some investors might want a higher payout to compensate for losses. If the high payout isn't likely, they might try to avoid losses altogether, even if the investment's risk is acceptable from a rational standpoint. Applying loss aversions to investing, the so-called disposition effect occurs when investors sell their winners and hang on to their losers. Investors' thinking is that they want to realize gains quickly. However, when investment is losing money, they'll hold on to it because they want to get back to it even on their initial price. Investors tend to admit they are correct about the investment quickly when there's a gain. However, investors are reluctant to admit when they make an investment mistake when there's a loss. The flaw in disposition bias is that the performance of the investment is often tied to the entry price for the investor. In other words, investors gauge the performance of their investment based on their individual entry price, disregarding fundamental or attributes of the investment that they may have changed. The importance of trading psychology. Containing fear and greed are the key to making money. Many skills are required for trading successfully in the financial markets. They include the abilities to evaluate a company's fundamentals and to determine the direction of a stock trend. But neither of these technical skills is as important as the trader's mindset. Emotion, thinking quickly, and exercising discipline are components of what we might call trading psychology. There are two main emotions to understanding and keep under control: fear and greed. Snap decisions. Traders often have to think fast and make quick decisions, darting in and out of stocks on short notice. To accomplish this, they may need presence of mind. They also need the discipline to stick with their own trading plans and know when to book profits and losses. Emotion simply can't get in the way. Key takeaways. Overall, investor sentiment frequently drives market performance in directions that are at odds with the fundamentals. The successful investor controls fear and greed, the two human emotions that drive that sentiment. Understanding this can give you the discipline and objectivity needed to take advantage of other emotions. Understanding fear. When traders get bad news about a certain stock or about economy in general, they naturally get scared. They may overreact and feel compelled to liquidate their holdings and sit on cash, refraining from taking any more risks. If they do, they may avoid certain losses, but they also miss out on some gains. Traders need to understand what fear is: a natural reaction to a perceived threat. In this case, it's a threat to their profit potential. Quantifying the fear might help. Traders should consider just what they are afraid of and why they are afraid of it. But the thinking should occur before the bad news, not in the middle of it. Fear and greed are the two visual emotions to keep in control. By thinking it through ahead of time, traders will know how to perceive events instinctively and react to them, and can move past emotional response. Of course, this is not easy, but is necessary to the health of the investor's portfolio, and not to mention the investor. Coming greed. There's an old saying on Wall Street that pigs get slaughtered. This refers to the habit of greedy investors have of hanging on to winning positions too long to get every last tick upward in price. Sooner or later, the trend reverses and the greedy get caught. Greed is not easy to overcome. It's often based on the instinct to do better, to get just a little more. A trader should learn to recognize this instinct and develop a trading plan based on rational thinking, not whims or instincts. Setting rules. A trader needs to create rules and follow them when the psychology crunch comes. Set out guidelines based on your risk reward tolerance for when to enter a trade and when to exit. Set a profit target and put in a stop loss in place to take emotion out of the process. In addition, you might decide which specific events, such as a positive or negative earnings release, should trigger a decision to buy or sell a stock. It's wise to set limits on the maximum amount you are willing to win or lose in a day. If you hit profit target, the money and run. If your losses hit a predetermined number, fold up your tent and go home. Either way, you'll live to trade another day. Conducting research and review. Traders need to become experts in the stocks and industries that interest them. Keep on top of the news, educate yourself, and if possible, go to training seminars and attend conferences. Devote as much time as possible to research process. That means studying charts, speaking with management, reading to trade journals, and doing other background work such as macroeconomic analysis or industry analysis. Knowledge can also help overcome fear. Stay flexible. It's important for traders to remain flexible and consider experimenting from time to time. For example, you might consider using options to mitigate risk. One of the best ways traders can learn is by experimenting within reason. The experience may also help reduce emotional influences. Finally, traders should periodically assess their own performance in addition to reviewing their returns and individual position. Traders should reflect on how they prepared for a trading session and how to date that they are on the markets and how they are progressing in terms of ongoing education. This periodic assessment can help traders correct mistakes, change bad habits, and enhance overall returns. You know the catchphrase: study it, analyze it, adapt it. Peace.